Hi, everybody. How are you all doing today? I hope you guys have had a fantastic day trading so far, and especially a cautious day. I hope you guys have thoroughly enjoyed the previous 11 lessons that we've covered thus far. And today's topic is going to be lesson 12. What are moving averages? And the swing strategy, guys. That's what we're going to be talking about. This guy right here. It's most likely going to be one of my favorite topics to talk about, and I'm so excited to have you guys here in this class. So today we'll be talking about what are moving averages, the swing strategy, and how we identify a short term or a medium term or a long term bull market and bear market. Hope you guys have taken so much away from these videos so far. I really hope that you guys have learned a lot. I really hope that it has thoroughly improved your trading so far. If it hasn't, guys, please don't give up, okay? There's so much room to grow, and I have no doubt in my mind whatsoever, and I have the utmost confidence in you guys that you guys will excel to the next level of trading. As you guys have seen a lot of my profits before, sometimes it's disgusting, isn't it? I mean, when I'm tweeting, hey, 15 minutes, I just made $300, or it's like, hey, 20 minutes of trading, I made $500, right? Yes, I am playing with a little bit of a bigger amount, but it's the percentages that matter the most, right? Sometimes the percentages are 1%, sometimes it's 5%. But if we keep practicing, and we keep failing, there's no doubt in my mind that you guys will be able to obtain these types of profits as well. So let's dive into it, guys. But before we do that, yesterday we talked about the common patterns and a breakout strategy. And in this particular video, you guys don't want to miss lesson number 12 right here, which is going to be talking about what are moving averages, okay? Moving averages, it's absolutely one of the most powerful indicators in my personal opinion, and it's also going to have to do a lot with lesson 13 as well. So lesson 12 and 13 will be pretty much joined together, where we're going to be talking a lot about the MACD, which is the moving average convergence divergence indicator that will be brought up in the next lesson. So let's get into this, guys. Let's get into lesson number 13 and talk about moving averages. So what are moving averages? Okay. Do you guys know what moving averages are? So moving averages, okay, what it does is it takes a specific amount of candles based on what number you have, and it smooths out the price action for you. So it takes an average sample of the previous candles and the price action, and it creates this smooth line that builds, right? But it's also known as a lagging indicator. And lagging indicators are good and they're also bad. So what a lagging indicator is because it takes an average sample of all the previous price data in the past, right? So it needs a lot of information to actually build up the information that you're seeing to smooth out that line. So it's not something that's in real time because it's taking an average, keep in mind, right? So if we look at other indicators, for example, such as RSI, or histogram, which we'll be talking about very thoroughly in the next few episodes or in the next few lessons, you guys are going to realize the difference very quickly between what a lagging indicator is and what a real time indicator is. So for example, something like an RSI, that's certainly guys, a real time indicator. But if we look at, for example, the histogram as well, that's also a real time indicator, okay? Because these things do not rely on previous price sample or anything for the past prices at all. If we also look at, for example, the level 2 order book, right? If you guys remember, the level 2 order book are the bids and the asks as well. So what that does is it gives you a real-time momentum change as well. So let's talk about how to get these on the charts first of all, which I'm sure you guys remember, right? So when you go to your trading view here, okay? Go to your trading view. Actually, let me actually exit my trading view and I'll show you guys right from the beginning of how to actually access this, okay? Let me just log out of my trading view here very quickly for you guys. And then we're going to go over it all together. Actually, I'll just go to Microsoft Edge because I don't want to actually log out here, okay? Okay, let's go to tradingview.com. And I'm going to show you guys exactly how to get this on there. So type in your chart for Bitcoin, whatever chart that you would like to see. Click on your interactive chart right here, okay? and then your charts will come up here on the white screen or whatever. And then go to your indicator tab right here. And I personally use EMA, which is the exponential moving average. And then there's also just moving averages, okay? There's also just a basic moving average, which is a very simple kind as well. The exponential moving average is weighted a little bit differently than the moving average itself. But I personally like to use exponential moving average. So you click on it one time, and then what you'll see is this right here, for example. Okay, you'll see these lines here on the charts. And then what you want to do is you want to double click on it, okay? And then you see where it says 9 here. You can change it to a bunch of numbers that you like 13, for example. You can change it to perhaps 21, okay? You can change it to perhaps 50, right? And notice that every time we change it, I'll show you guys again here, okay? This is how it originally started out, right? This one was the 9. So what the 9 does is it takes the previous 9 candles only. One, so maybe something like that, right? 1, 2, 3, that might be a little bit too much right here. So it takes 1, 2, 3, 4, 5, 6, 7, 8, and 9. So it just takes these 9 bars to give you an average of the price, right? So notice that when I actually change the moving average, okay, I'll show you guys right here. When I change it to, for example, 21, it's actually going to smoothen out more, and it's not going to nearly move up and down as much, okay? So I go to 21, notice how it looks now. It doesn't really move up and down as much, and it's more consistent with the way the lines actually are, right? Now, let's say I actually go to 50. So what 50 will do is it'll actually take the price of the previous 50, right? It'll take the previous prices or the prices of the past 50 candles now instead of 21, right? And now you're going to get an even smoother line. And this gives you an overall average gauge based on all 50 candles of where the price actually was. So just imagine a line that's taking the average of it, okay? So if you take 100, guess how many candles that will actually take up instead now. So it'll take up 100 candles now, right? Let's say that we have 200 candles, okay? 200 candles. Now you see it smoothen out even more, right? So let's get into how we identify, first of all, a bull market or a bear market, okay? So personally, on mine, guys, I have it on these particular numbers, and I'm going to write it out, okay? So let's Google, first of all, Fibonacci numbers. So let's go to Fibonacci numbers right here, and let's talk about what these are. So the Fibonacci number is taken by, it's for example, 1, 2, 3, 5, 8, 13, 21, 34, 55, etc., right? And it just keeps going and going and going like that. And the way that the Fibonacci numbers are given is that the next one is you take 1 plus 1 is equal to 2, right? 1 plus 2 is equal to 3. 2 plus 3 is equal to 5. 5 plus 8 is equal to 13. 13 plus 21 is equal to 34. 21 plus 34 is equal to 55, and so on, right? You take the past two numbers, you add them up, and that's how you're getting your sequence of numbers that comes after it. So what I personally use is a number that's according to the Fibonacci, right? I personally use 8, 13, 21, 55, 100, and actually 200. Okay, I use the 200. I skip 100 entirely because it's not as useful to personally me, but definitely add 100 on there if you would like to have 100. And make sure you guys are, you double click on the line. Make sure you can choose a color to whatever you want. You can make it green, for example. You can make it red. You can make it, pink or purple, whatever color you guys like. On a white background, I personally like to keep it, on a black background, I personally like to have my big one on white right here, right? Okay, now we're going to talk about what we consider a bull market, right? Let's say, just as an example, we're looking at a bull market. Okay, let's go to, for example, a weekly chart. What we see on the weekly chart, guys, is that we are still on a very large uptrend, right? So if the price is actually above a specific moving average, right? For example, if it's above the 50 moving average, or I will say 55 moving average right here, then that means that for the past 50 candles, we are on a really good uptrend, okay? Now, if we are supporting well above, for example, the white one, which is the 200 moving average, so it's taking basically the past 200 candles, then that's considered on a very, very large uptrend actually, right? Whereas if we are only supporting it above, if we are supporting it on only above, for example, the 8 EMA, which is not really used often, okay? It's not really used often at all. I should probably delete it actually, but you know what? I use it for day trading. It's pretty good to me. If we're supporting over the 8, that means that we're on a shorter term bull market, right? But if the lines are actually below if the candles are actually below the candles, then we would consider that more of a bear market. Now, the cool thing about EMA, guys, is like this, okay? Think of it like this, okay? Think of it as a line that's an elastic band, right? So we'll use the yellow, for example, because the yellow is the most common one for the 50 moving average, or 55 rather, okay? So if it snaps too far away from the yellow band, what it'll actually do is just snap right back closer to it eventually, right? So if it goes down too far, it'll snap back to it. It likes to take the average of it, we have to remember. And because it's taking the average of it, when it gets too far away from the line, it tends to snap back, right? So if it goes too far down, even if by a little bit, it snaps back up. If it goes too far down, it snaps back up. If it goes too far up, it snaps back up. If it goes too far up, it snaps back down. If it goes too far down, it snaps back up. If it goes too far up, it snaps back down. If it moves below it, it always likes to move very, very close to the line, right? So we always have to remember that about moving averages, of that. If it's above a specific number, that's considered an uptrend. If it's below a specific number, then it's actually considered a downtrend, right? So I personally love to use the 55 moving average because it gives me excuse me there, it gives me a really good sample of confirming if it's an uptrend or a downtrend. So let's look at it on different time frames, okay? And we're going to talk about how these short-term trends on a lower time frame can actually translate to a larger uptrend on a bigger time frame, okay? I'm going to show you guys exactly what it means. So what we want to do eventually is find it happening on a lower time frame, and will it actually cascade and carry over to a larger time frame? And that's one of the biggest things that we always want to confirm, because if an uptrend is happening on a 1 hour chart, ideally we would like it to start happening on a 2 hour chart as well, or a 4 hour chart, which confirms a greater degree of that trend, okay? So let's get into a really good example, okay? Let's talk about the 30-minute chart, for example, right here, okay? What we see is that whenever, once again, the candles and the price action moves below these moving averages, for example, if it moves below the 55 moving average, then we're basically confirming a shorter term downtrend, right? But if it moves below the 200 moving average, because it's a larger number and because it takes even more candles as an average based on the past prices, then we're actually confirming an even greater degree up or downtrend, right? So just as an example, we see the 30-minute trend below the 55 moving average, right? And then eventually it bounces off of these moving averages. So think of moving averages as actually a line that can be a resistance or a support. So what we do is we say, okay, well, it fell below the 55 moving average. And are we actually going to bounce off of the next moving average, which is say the 200? And surely enough, we bounce a little bit off of it, and then we ended up coming down, right? So then, because it actually broke through the 200 moving average, we'll, for example, go to the 1 hour chart now, and we'll say, okay, on the 30-minute chart, it fell below both the 55 and the 100 moving average, but on the 1 hour chart, will it actually bounce off of the 55 moving average or the 200 moving average? And we say to ourselves, okay, well, on the 1 hour chart, it fell below the 50 moving average right here, right? But it actually pretty much bounced off of the 200 moving average, right? So that's how we look at it. And then now we go to the next time frame and we say, well, you know what? On the 30-minute, it fell below the 55. On the 1 hour, it fell below the 55. On the 2 hour, it fell below the 55. Will it fall below on the 3 hour? Yeah, it's falling below the 55 on the 3 hours. So we're confirming an even greater degree uptrend because we are seeing it on the higher time frames as well. Will we see it on the 4-hour time frame? Yeah, we are actually seeing it on the 4-hour time frame as well, right? So that's not really a good sign if you guys think of it like that perspective, right? Now, if we go to the daily, we say, okay, well, at least on the daily, it's actually still above the moving average over here. So let me show you guys, just as an example, on Bitfinex. Okay, we'll get even more charts on here as well. Okay, so if we go to Bitfinex, for example, we'll say, is the 6-hour showing a greater degree downtrend? And we say, okay, well, the 6-hour chart right here is actually just about to bounce, or it did bounce off of the 55 moving average. So we say to ourselves, well, the 4-hour fell below, or almost is falling below the 55 moving average. So will it actually hold up in the next time frame? Okay. Will it hold up in the 12-hour? And it definitely is holding up so far. So that's the best way to think of moving averages. Okay. So what we also say is, all right, well, on the 30-minute time frame, it fell below the 200 moving average now, which is the white line, which confirms an even greater degree downtrend. And then we say, well, will the 1 hour, right, actually end up confirming that as well? And yeah, the 1 hour is actually showing that it's actually downtrending on a greater degree as well. So on the 2-hour chart, we almost nicked it, right? On the 2-hour chart, we almost nicked the 200 moving average there and bounced off of it. Now, let me show you guys a really good example of a resistance, okay? We say to ourselves, all right, well, if this bounces upwards, right, will it hit any of these moving averages? Well, this one actually almost hit this moving average right there. But if we look on the 1-hour chart, what we see is that it hit the 200 moving average and simply just bounced off of it. So if one moving average breaks on a time frame, try to look at it from another perspective of another time frame, right? So if it breaks, for example, if it breaks on, say, a 15-minute chart first, right? Oh crap, it broke below the 100 and the 55 moving average. Let's see if it's actually going to bounce off of the moving average, the 55 or the 200 on the 30-minute chart. It actually bounced slightly right there. So that's the best way to think of it. And now I want to explain to you guys something called a golden crossover, okay? And also a death cross, okay? Death cross and golden crossover, like that, okay? So let's explain what a death cross is. A death cross is when the 200, we'll say the 55. Now keep in mind, when I say 55, I'm really referring to 50, okay? It says I personally use 55, is when the 55 and 200 moving average crosses. Specifically, the 200 moving average moves above, okay, above the 55. And then the golden crossover is defined as when the 55 and 200 moving average crosses. Specifically, the 200 moving average moves below the 55, okay? Does that make a lot of sense to you guys right here? So basically what this is saying is that the larger moving average on the death cross, it ends up, okay, just think of it like this, okay? If this line here is the 55 moving average, right? Then on a death cross, the 200 moving average up here is actually end up crossing over, and it actually becomes on top, okay? It becomes on top, which is acting as a resistance now, right? So it goes from high to low. That is what a death cross is. And then a golden crossover is the other way around, where the 55 moving average is above the 200 moving average, right? So the 200 moving average on a golden crossover is actually acting as a support to support all of it above. So think of the moving averages as something that likes to push it up, okay? It pushes it up if it's actually on an uptrend. And other way around is if it's on a downtrend, the 55 moving average is pushing down on the candles, and then the 200 moving average is pushing down on everything below it. So once again, on a golden crossover or an uptrend, the 200 moving average is taking a lot of the past price action, so it's actually holding it in a way where it's supporting above all of it with the bigger number on the bottom. And once again, the death cross is when it's actually pushing it down, right? Pushing it down with the bigger number on the top. So that is the best way to think of how crossovers work and how moving averages work as well when it comes to supporting and resisting. Now, this is going to be a very detailed video, guys, okay? We're going to talk about the swing trading strategy. So it's actually going to be a video that's much longer than the other ones. I'm probably guessing well over an hour because, guys, the strategy, okay? The strategy is really critical, and I want you guys to really understand how these moving averages work, okay? This is by far one of my favorite moving averages that I have honestly seen before, or moving average strategy. And this swing trading strategy, guys, it's really ideal for people who don't have a lot of time to invest, okay? Whether you're a student, for example, obviously as a student, you don't have time to make 20 trades a week. You might have time to make 1 or 2 major trades a week. So this strategy is going to be perfect for you. Whether you guys are parents and of course you have a family, you don't have time to obviously look at charts all day, right? You have a full-time job, you have a family to take care of. So this swing strategy is, try saying swing strategy many times. Swing strategy, swing strategy, swing strategy. It's actually really hard. So this swing trading strategy will actually be very beneficial to your lives because it doesn't require a lot of time and actually monitoring, right? All right, let's get into this moving average strategy. So I'd like to point out one more time that on an uptrend, what we see is the larger number on the bottom, and then the smaller numbers are on the top, right? So the big number is actually supporting all of it below. But on a downtrend, what we see is the bigger number on the top, and then the smaller numbers are actually below it. So the bigger numbers will actually act as a support or a resistance. So on an uptrend, for example, the 55 or the 200 moving average will act as a support, but on a downtrend, the 200 and the 55 moving average will act as a resistance. So let's get into how they actually look. If you guys notice right here on an uptrend, we see the bigger number, 200, and then above it, we see the 55 moving average, and then we see the 21, and then we see the 13, and then we see the 8. But on a downtrend, what we actually see is the bigger number on the top, the 200, and then the 55, and then the 21, and then the 13, and then the 8. So it looks like this, and we're actually just going to draw it out to give you guys a really good visual representation of it. So we see on an uptrend right here, we're just going to label it very clearly so we know which one is an uptrend and also which one is a downtrend, okay? So this is a downtrend right here. Okay, so we see that on an uptrend, the white line is below, and then we see the yellow line above it, right? And then we see the orange line, for example, and then we see the purple line, which is now the 21, and then finally we see the blue line, which is the 8, like that. But if we look at it on the downtrend, what we see is the other way around, okay? We're going to go with white first. We see the bigger number, the 200 on top, and then we see the yellow one right there. That's now below it, okay? And then we see the orange one that's in the middle, which is the 21. And then we see the purple one, that is the 13. And then finally, we see the smaller number, which is the 8. So it starts to fan out like that. So let's also make sure you guys see this very clearly, because I want to make sure that you guys understand this 100%, okay? So we see the 200 right there, and then we see the 55 right there, and then we see the 21, which is the orange line right there, and then we see the 13, and then we see the, finally, the small one, the 8. The 8 doesn't really matter as much on a bigger time frame, but nevertheless, I personally still use it because I'm a day trader, but this strategy is more so going to be specifically for swing trading. So once again, we see the 200 on top there, then the 55, and then the 21, and then the 13, and then the 8. So this is my favorite swing strategy right here that I like to use. And I would recommend taking a screenshot of this or just save it somewhere so you guys have a really good reference using EMA. So definitely one of the most powerful tools that we can use. And I'm actually going to go over it in incredibly high detail with you guys. And we're going to go over tons of examples. And I'm going to show you proof in the pudding of how this actually works very well. All right, so now that you guys have the definition of what is considered an uptrend and a downtrend, according to the EMAs that I drew, we're now going to go over when is an actual breakout and when a breakout upwards or downwards actually, okay? So another thing I wanted to define very quickly is a golden crossover and a death cross, okay? So what is a golden crossover and what is a death cross? So usually something like this happens, right? Where we're seeing it support. See, let's just say the 200 moving average is actually supporting the 55 moving average below it, right? A death cross happens when the 200 moving average ends up crossing to become above the 55 moving average, okay? So let's say we're talking about a golden crossover now, okay? A golden crossover, let's just say that the 55 was actually above it, just like that right here, okay? Or sorry, below it, just like that right there. So what a golden crossover would mean is when the actual 200 moving average, okay, ends up crossing below it. So this needs to make entire sense, right? So once again, a golden crossover is when the 200 moving average ends up supporting all of it from below. And then a death cross is when the 200 moving average ends up supporting all of it from above, like that, right? So, and we're going to go over a lot of different examples. You guys know exactly what I'm talking about. Let's go to a weekly chart here first of all. Let's just say you bought it on the breakout. So whenever it starts to fan out, right? We see it on the downtrend pattern according to these lines. And then when the uptrend pattern actually begins, where the 55, just as an example first, is now supporting below all of it. So it goes from 8, 13, 21, 55. As soon as it crosses over like this, where you're getting this type of fanning type of pattern, you basically enter a trade. That's what you guys do. Okay, you enter a trade, and the defined risk to reward setups are actually not all set in stone quite yet because you don't know where these targets are actually going to head to. So what you want to do right now, if you guys were an investor, you wouldn't even think about closing your position quite yet. You'd still be holding it because what this strategy does is it prevents you from taking profit too early, okay? So instead of taking profit too early, it gives you a gauge of when to actually ride it and for how long, because there are many chances of it actually crossing over that could have made you take profit, but you may not want to take profit early if you're using this strategy because it gives you a very defined region to take profit. So just as an example, okay, this is the last time that we had a golden crossover according to the daily charts. So that is when the 200 moving average right here ends up crossing below and supporting all of it, right? So if you guys notice right here, you'll notice the 8, you'll notice the 13, the 21, and then the 55, and then finally the 200 crossing over. So right here, honestly, would have been a very good time to enter a trade. You can even purchase it earlier, right? So that's where you could have entered a trade on a crossover. But realistically, you would want to anticipate it earlier and perhaps buy it on the crossover right down over here, okay? So right here would have been a very good region, 240. Now, where would you actually close your position? Now that you caught where it broke out, you want to time it so that you're not going to sell it too early, okay? You're not going to sell it until the white line and the yellow line end up moving very close to each other. So you could have sold it here, right? But you didn't. You could have sold it there, but you didn't. You could have sold it there, but you didn't. You could have sold it there, but you didn't. There, but you didn't. Because you're following this 200 and the 55 moving average strategy. So you're going to sell it when it's actually getting very close, the white and the yellow line. So right here would have been a very good place to sell it, right? 8,700. I know you guys might be arguing with me and saying, hey, I could have actually sold it around this region right here, around the 1900 region, right? Yes, you could have sold it there, but you could also have sold it at maybe 4,000 or 5,000 or 3,000 or 2,000, right? You could have sold it at a much, much cheaper price. But what this strategy guarantees is that you follow these moving averages to show you when the momentum is pretty much dying off. And if you can catch it when the momentum is slowly dying off, you're pretty much going to ensure that you're going to catch it right at the peak of when to sell it and when to buy it near the bottom. So let's look at many other strategies. And this strategy actually applies pretty much for every single time frame and for every single coin as well. So let's just go to, for example, EOS, okay? Actually, I'm already on EOS. Let's go to EOS daily chart just as an example. So on a daily chart, sometimes you guys got to keep in mind that sometimes there's actually not 200 moving averages available. And the reason why they're not available is because the previous history just doesn't have 200 bars of data yet. So keep in mind that the 200 moving average will actually take a compilation of the 200 previous candles, right? And the 55 moving average will take the past 55, and the 21 will take 21, etc. So sometimes we actually don't have enough data to use the 200 moving average. So what we want to do instead is use the 100 moving, or sorry, the 50 moving average strategy. So it's the same strategy, guys, right? When we are starting to see this fan out, so yellow, and then the next one will be orange, okay? And the next one will be purple. And the next one after that will be the bluish color, right? That is what we would consider an uptrend, okay? That is what we would consider an uptrend, right? Yellow, 55, orange, 21, purple, 13, and the blue is 8. When you start to see it fan out, just like that, where you're starting to see it go upwards like that, that is where you want to buy and enter a position, okay? You want to enter a position right around here. Anywhere around there is fine. And you don't really know your exact risk to reward setups yet because you're gonna sell it. We're on for these ones because we don't have a lot of data for the 200. What we'll say is we'll sell it when we actually get the crossover. Okay, so we buy it when it crosses over just like that. All right, where the 55 is starting to fan out, and this is the swing strategy. We got to remember the swing strategy involves buying it on a particular breakout when it looks like that. And then we sell it when it actually crosses over. So we sell it when the yellow moving line is actually resisting all of it from the above side, right? So then we would have bought it and entered around 83 cents. Okay, I know the RSI might have seemed kind of high, but it definitely broke into some very nice regions. And then we would have sold it roughly around here, around $9.51. Yes, you could have sold it at $18 as well. But guys, this strategy, once again, it ensures that you only sell it when you were actually reaching a very pivotal point, okay? And that pivotal point was clearly around the $9. That's where it started to change from an uptrend to a short term or medium term bear trend. So, once again, guys, this strategy allows you to ride it as much as you possibly can, and it prevents you from selling too early. So, you could have sold it perhaps there, $3, $4, $5, $6, $7, but this strategy guarantees that you at least rode it to $9.61. And you could have actually entered a short position as well here, okay? You could have entered a short position right around here, $9.50 ish, and you could have rode it to where it crossed over again to about $7 range, right? So that would have been a phenomenal place for you guys to take profit from around 950 ish to about $6.60, because this guarantees that, hey, you could have taken profit there at $4, but what if it actually just kept going lower? So once again, the strategy is awesome, guys, for riding as much as you possibly can. So for example, right here, you guys have had a great chance to, let's just say we go on a 3-hour chart, okay? We go on a 3-hour chart and it has more data now. It actually has the 200 moving average showing because it now has more than 200 candles in the past. So let's say you actually bought it on the golden crossover, right? So you would have bought it literally right here, or you would have anticipated this, to be quite honest. You would have anticipated a crossover and you would have bought it around $6.40, right? And you would not sell it until we actually get to a golden cross, or sorry, a death cross, where perhaps the white is actually going to move above the yellow, right? So then we just keep going. No reason to sell it quite yet, actually. No reason to sell it. Here we go. Here's a reason to sell it right here, okay? So you would have rolled this guy from $6.50 all the way to where we get this crossover right there. So you would have made yourself 138% profit. So let's go to another coin and see if we can actually do this on every single coin. Okay, let's start off on a high time frame, guys. Okay, start off on a high time frame, and then we're going to talk about playing this on a lower time frame as well. So here is where I told everybody to pretty much start buying IOTA, right? This is where I basically told everybody you need to start buying IOTA around the 34-cent range. Honestly, guys, like that's what I told everybody. Take a look. It was really, really easy to play this. I just told everybody, you guys really need to buy IOTA around these ranges right over here, okay? And surely enough, this wedge ended up playing out very nicely, just kept getting tighter and tighter. That's where I entered my IOTA position at 35 cents, and I made literally a 300% profit because I sold it around $1, believe it or not. $1. Then I entered another position from around 60, 70 cents, and I rolled that guy to almost $3. Didn't get quite that high, but I made some nasty gains on it, guys. Like we're talking 4, 5, 6, 700% gains on it, right? Just by following some of these strategies. So if you take a look on IOTA, where would you have bought it, guys? Okay, you would have bought it right here on the breakout. That's where the fanning started to happen, right? That's where the golden crossover-ish happened with the 55 EMA. So you would have bought it around, perhaps anticipating around 55 cents you would have bought it, okay? 55 cents you would have bought it. And yeah, sure, you could have sold it up there on a higher time frame, but because you guys might not be familiar with different strategies quite yet, which I'll actually introduce slowly if you guys would like, okay? So let's just say you bought right around here, okay? And then what you would want to do is you could confirm an uptrend, the top of an uptrend pretty much with either Elliott wave or simply say on a 4-hour chart here, okay? Basically getting double tops right there. So as soon as we peaked off at the double top, I definitely would have sold it, or I would have went over to a lower time frame and sold at a crossover. So you can pretty much buy on the crossover right here on a lower time frame, and you can also sell it on a lower time frame as well. Personally, myself, I probably would have started selling it right around there. So yeah, I took my profit earlier at $3, like right around here. But if I followed this particular strategy, I would have actually made myself about a 500% profit. So pretty good strategy there still, 500%. Can't really complain about that, guys, okay? So let's look at it on a downtrend as well. So let's say you're actually shorting the market and you've now confirmed that, hey, January, December-ish, we're now entering a bear market. Let's say you entered it on the 4-hour time frame, okay? You entered it on the 4-hour time frame where you're seeing this death crossover. So now the 55 moving average is now below the 200 moving average. So we see the 200 moving average is actually supporting all of it from above, right? So because it's supporting all of it from above, you don't exactly know where the supports are going to be quite yet, but you would typically imagine the next lower points is kind of right around this region, right? So even before confirming that that's your risk to reward, and that's the play that you would have actually taken, or sorry, even before confirming that that's where you would have closed your position because you have no idea and no way to know it's actually going to get there, you can just loosely draw out your risk to reward ratio, set your stop loss. I'd probably say around like a 5% loss. It's kind of what I'm cool with. And you guys could have easily made at least 75% profit there. 75% profit's kind of cool, guys. You know, or you could have you could have most likely closed your position right around here, guys. So if you close it here, that's where the crossover actually happened, right? You still would have made yourself a good 63% profit there. So now that you guys know exactly how to short it as well, let's say you entered a long position, right? You entered a long position, you buy it on the golden crossover right here, or you would anticipate the crossover because it was so parabolically moving upwards that you'd buy on the golden crossover, okay? And then you would basically sell up to you guys where the 55 moving average crosses over. That's where I would have sold it on a 4-hour chart, okay? I would have made myself a good 78% profit as well. So every single chart, excuse me, hiccups there. Every single coin that we're looking at, it seems like there's a lot of ways to profit using this strategy, right? So let's just say you're looking at Ripple on I don't know, let's just say we're doing it on a 3-hour chart or something, right? So on Ripple, you guys would have bought it right here. You would have bought it right there around the 23-cent range where it started to fan out, okay? Now you got to make sure that you got a really good eye for this, right? Here is you could have bought it there when it fanned out, but it was much easier to tell right around there, right? So what you want to do is you want to buy in a breakout as soon as it starts to fan out around this region. Never mind the R sign stuff, guys. Like, don't worry about those because this is a very different scenario, a different strategy that we're going with, right? You would have bought it around there, okay? Let's just say we end up buying it at the crossover of the 200 and the 55 for the golden crossover, but we actually end up selling it where it crosses over only for the 55. So if you bought it right here, okay, and you sold it right around here, you would have made yourself a 773% profit. It's kind of a big profit, guys. 773% profit. Think of that. Just by following a bunch of lines on a chart, right? I mean, it's not really that difficult, in my personal opinion, to learn this strategy. Now, let's say we actually looked at it on a downtrend, okay? Well, you confirmed your downtrend. That's where you obviously closed your position, right? Let's just say we're using the 55 strategy and you would have closed it obviously right around there, right? Actually, let's be consistent. Let's use the 55 one right here, the crossover, and then we'll also close our position at the 55 crossover right here as well. Notice the 55 is now supporting below all of it. So you would have made a profit roughly on short of about 66% as well. And this would have been over the course of about 30 days, right? 66% in 30 days. It's pretty good, guys. If you had put in $1,000, you would have made $600 about, right? If you had put in $10,000, you would have made $60,000 if you put that into perspective like that. So yeah, that's where you would have taken it, your profit. So let's say you entered a long position on the 3-hour chart, for example, okay? You would have entered it right around here and you would have closed it right around there. Well, that's a pretty good profit as well, where you'd be profiting about 41%. So this strategy doesn't really fail often, if you guys have noticed so far, right? It's definitely one of the more powerful strategies, in my opinion. And I think it's gonna do really well. If you guys keep studying this strategy, honestly, you're gonna do very, very well studying it, guys. It's one of those strategies that I use heavily for a super long period of time when I was still newer to trading, and it actually made me a good amount of profit. You can look at it on any coin, guys, like any coin. Let's just say you ended up buying on the breakout here. So this would have been in March, okay? You would have bought it in March and you would have sold it
when it crossed over again, like roughly around, I'd probably say right here would be a better gauge, right? Instead of using the 200, we can also just use the 55 or even right there. So if I had bought right there and I had sold it right around there on Ethereum Classic, that would have still been an 885% profit there in how long? Like we're talking about in 3 months, you guys would have made 800% profit there. And guys, these 800% profits, they come a lot. Like they come really, really often. It's just a matter of spotting them and learning how to use this specific strategy, which we're going to go over a lot of examples, guys. So let's say we go to random chart on a 4-hour chart, okay? Bitcoin Cash, for example, as well. So Bitcoin Cash, and let's just make sure we follow the strategy of the 55 and the 200 moving average. So we'll be consistent. So let's say we're buying it on the crossover of a golden crossover, and then we sell it on death cross, right? So 55, the 200 moving average now needs to become on the bottom. So when it's now on the bottom, it's now supporting all of it. And then we take a look at the moving average of the 200 resisting all of it now, and that's pretty much where it was. So you would have bought on the breakout around $368, and you would have sold it at around 2K, and you still would have made about 500% profit. Now, one might argue I could have sold it at $4,000 to make way more money, but could you have really, right? What if it actually just came down here and it never actually crossed over, it just bounced off of it and it kept going upwards, right? So once again, what this strategy does is it guarantees that you're riding it to its maximum potential. So let's say we look at a short position as well now, right? So this is the short position. You would have closed it right there, and you could have also entered a longer term swing position for your short as well. And if you entered your short there and you closed it when it crossed over again, well, in 84 days, you would have made yourself 64% profit. 64% profit is a pretty big deal, guys, right? You put in $10,000 in literally 3 months, you would have made yourself $6,000, right? Which is some serious money to be looking at. Now, if you look at it on the uptrend as well, okay, just on Bitcoin Cash here, you would have bought it on the uptrend right over here, right? Right around 850-ish. And you don't really have a reason to sell it quite yet because it hasn't crossed over. What if this actually never ends up death crossing and it just bounces up and it just keeps going up and up and up and up, right? So this strategy guarantees that you're not actually taking profit too early and that you're going to ride it to its maximum potential. So you can even do it on a small time frame, guys. Let's say you go to a 30-minute chart. Like swing trading is really good for 30-minute charts, in my opinion, right? Let's say you want to swing this position for 5 days. So what swinging refers to is taking an extended duration for a position, right? Instead of day trading every single day, you might be holding a position for a week or two or even 3. I guess the definition of swing can be very loose, so it more so just comes down to how long you're going to be wanting to hold it. Whereas a traditional investor, what they'll do is they'll invest for a very long period of time, right? So for a swing position, for example, on a 30-minute chart, you would have entered a position when perhaps it crossed over, right? When it crossed over. Here, it kind of crossed over. So let's be consistent and actually enter a position. If you entered it when it did cross over, right around here pretty much, right? You got to make sure you give yourself a very generous stop loss. Notice the stop loss here is about 7% or so. You got to make sure it's very generous. And you would ride it until it crosses over again. So you would have rode it to roughly that level, I'm guessing. And oh, okay, it actually never crossed over, right? It never crossed over yet until right here. So you actually gained a little bit more profit on it. So take a look. So this is where you actually ended up crossing over instead. So notice right here, looks like it was about to cross over, but it didn't. Looked like didn't. Looked like it was going to and finally did, right? So sometimes you can get like a fake out. So you would have taken your profit right around there. This one would have been a good 111% gain as well for a swing position. And this would have been over the period of, for example, 22 days, 3 weeks, not bad. So let's say you entered another swing position on a short, okay? You would have entered on a short right here. You wouldn't have actually made a lot of money on this particular short position because, well, you entered on the crossover, right? Set your stop loss somewhere up there. You actually ended up breaking even, right over here at the cross. So you ended up making like a 2% gain, almost breaking even. But here is would have been the nice one, right? You enter on the crossover and then you sell it when it actually crosses over again right there. So that would have been a good 20% gain as well. Let's look at it on a 30-minute chart for a short position. You would have entered a short right there, okay? And now you actually have no reason to close your short position yet because the white line is actually not supporting below all of them quite yet. So you would still be in a short position from 1600 to 13-ish. So there's many, many different ways to play this. Let's say you're actually looking at Bitcoin as well on a 30-minute chart, guys, right? Let's just say for the past few like month or something, you would have entered a short position here. You would have closed it right there for 15% gain, right? Actually, you wouldn't have closed it yet because it never actually officially crossed over. So you would have entered there. You would have closed it at the official crossover right there at 31%, right? These ones are too small, so you don't want to enter it yet. But if you did enter a crossover, you would have entered a trade here for the crossover, you would have broken even. If you entered a trade here, you would have broken even as well for these little ones. Let's look for a bigger one, like right here, for example. You could have entered a trade, and this one could have yielded 5% profit. You could have shorted here on the crossover. It would have yielded a 2% profit, right? You could have shorted here on a actually you wouldn't have closed your position at all yet there for your 2% because it never officially crossed over. You would have opened your position from 9,500 and you would have pretty much taken your profit right around there for a 10% profit, right? Now you would have also entered a short position here on a 30-minute chart for swinging, and you would have no reason to even close your position quite yet because it hasn't crossed over. So now it's just a matter of waiting to see what coin does what. Like I'll go to random chart, like for example, EOS 30-minute chart here as well, right? You would have entered a short position right there where it crossed over on a 30-minute chart, and you would not be closing it until perhaps sometime soon over here. Because this is what the crossover strategy does, guys. It guarantees that you maximize your profit. It guarantees that you ride it as long as you possibly can, and you might miss out on some profit because you didn't actually catch it at the very top or close it at the very bottom. But what it does guarantee is that you're not going to close it too early at all. So on EOS, let's just say it's about to crossover, you'd still be up 28%, right? So these are really nice swing positions to be taking throughout the day. So let's just say you ended up, let's just go back to Bitcoin on a daily chart and add some more things to it. So you would have bought on the crossover, realistically, right around here, okay? 2015, you would have bought on the golden crossover. And how would you have been able to time it so that you're getting some very good profits, right? How are you going to be able to time it? Well, the way I would have done it is I honestly would have looked at this histogram right there, and this would have been it for me. It just ticked a little bit too high with this bearishly diverging histogram and also this crossover right here that happened on December the 19th. Actually, December the 18th, about 17, 18, I would have anticipated the MACD crossover. For the people that are not familiar with that, what the MACD crossover refers to is this crossover right there, where the fast length, the 12 and the 26. So I use the 12 and the 26 right here. They end up crossing over, the blue and the red crossover, which signals to the market that it's most likely going to go to the negative histogram side. So you could have combined it with that in particular to give yourself a good gauge of when the top is. So it doesn't really matter what coin we take a look at, guys. Let's say we went to Ethereum as well, right? You guys are seeing proof in the pudding of how reliable this particular strategy really is, guys. Man, I made a killing off of Ethereum, to be honest. Like, can you guys imagine for a moment with me? Okay, just imagine for a moment with me buying Ethereum right here. Okay, this is where I bought Ethereum. Do you guys see that? You guys see my price right here? It was like $10 about. Literally, it was $10. That's where I bought my Ethereum. And all that I want to do is teach you guys how to ride it. Honestly, guys, I just want to teach you guys how to ride this bad boy, okay? And I've known about this moving average strategy for a very long time. So I bought it literally like right around the breakout, guys, like right around the breakout around here, January, February, March-ish, where the 55 moving average was breaking out. Then the 200 moving average started to show. So that's where I bought my 200 Ethereum on top of the however 100 that I've had it already as well, right? So I've been using this as a gauge the whole time, right here as a gauge. And I follow the exact same thing as Bitcoin, or that we just talked about, where it's reaching some really high histogram numbers, right? And as soon as it started to downtick like that, okay, I didn't actually sell mine like way up there. Okay, I actually didn't. I was panicking right around here, right? Right around there in July at about 260, 270, but it actually bounced back up to like the 300 something ranges. And that's where I just felt in my bones that it was just retracing way too hard. And because it retraced way too hard, and we actually ended up getting like a 30% drop that day, it bounced back very quickly. We started to bearishly diverge, and I took my profit. It was like a $80,000 profit on just those two Ethereum. And then after that, I had even more Ethereum because I was mining as well, right? I was mining on 36 GPUs. If you guys go to the Ethereum forums, you'll find me very active in it as well. Not right now, but 3-4 years ago, very active. I was helping the community get started. So if you take a look at the moving average strategy, let's say you never sold it, you would have entered around $10, right? And you'd still be holding it right now till about $606, or maybe even to 300 something. That's where you'd have sold it, right? But realistically, as a smart investor that you guys are, you guys probably would have looked on a lower time frame as well, right? So you would have bought it at the 300 something dollar range, okay? $300 something or $10 range. And realistically, the first sign to sell was going to be right here, okay? The first sign would be about $288, right? And then the next sign to buy it would be right here around the $217 range, 217, and then you sell it again at 320, right? You could have entered a short position when it crossed over here, but you would have only made about 10% profit. Here, you could have entered a long position, right? Right around here, but you crossed over again, you would have only made 5% profit there over 25 days. So here is the big one for Ethereum. You would have entered it when it crossed over again, so right around this range, around $315, and you would have rode it all the way till about $1,058. So it works on every coin. Let's take a look at Litecoin to see how this is doing as well. Guys, trust me, like when you guys get this strategy down, it becomes so easy. Like I kid you not, it just becomes so easy, and you guys are gonna be like, what? This strategy is that easy? Yeah, it really is, guys. Like Litecoin, that's one of the ones I called out as well, right? I kept urging for everybody to buy it at where was it here? $56. Yeah, I urged everybody to buy it at $56 there. That was the first breakout, but I was also urging people to buy actually no, I wasn't. I wasn't even on YouTube and Twitter back then. So around the $4 range, you guys would have bought, okay? You would have bought right there at the $4 range, and you would have just kept going and kept going and kept going and kept going, and you would not have sold it until pretty much say this crossover here, right? Around $200 you would have sold it, or even 140. This way, once again, it maximizes your profit. You guys will always argue with me and say, oh, I could have sold it around the, really high ranges, up to $300-400, right? Well, to employ targeting up there, you would have to know a little bit more of an advanced type of technical analysis, which we'll be introducing later, right? I would have sold it probably at the MACD crossover there, or I would have looked on a lower time frame. I would have bought it at the $4. I probably would have sold it around here, the $255 range. Makes a lot of sense. So we look at, for example, Tron as well. We can look at honestly at any single coin, because these coins will all tell a very similar story. So on a daily chart, there's nothing to really show. But let's say we go in on the 4-hour chart. There we go. The 4-hour chart right here, guys. It was only recently released. So you guys would have bought it on the breakout right around here. Okay. Right around this region. Say around the 43 cent range. And you would have sold it when it crosses over to up there about the 82-cent range. So you guys would have made yourself a nice 100% profit. So what other coins can we look at, guys? I mean, it's honestly every coin, right? Let's say we looked at Cardano. So we looked at Cardano as well. And let's just say we went on a 4-hour time frame. You guys would have bought it right here on the crossover. Right there, okay, on the crossover, 392. And then you would ride it until it actually crosses over again. So right there. So you would have sold it at the 4,800 Satoshi range still. So that still would have been a nice profit. So once again, you would have argued, well, I could have sold it up there. Probably not, guys, right? You're never going to be able to time it like that. So what this strategy ensures is that you are taking your profit as soon as you've confirmed that the uptrend is now over. And if you are able to short this coin, I don't know if any exchanges could short it, but you basically would have shorted a position from right there. That's where the crossover was. Actually, it would have been more like right here, okay? Right there. And you would have closed it where the crossover roughly was, right around here. That's more realistic. So you could have made yourself a nice 35% gain there as well. So I've shown you guys a lot of examples already. And have you guys noticed all that it's about is waiting for some sort of crossover, whether it's the 55 moving average crossover or the 200 golden cross or death cross crossover. It's just a matter of learning how to use these lines in a very efficient method. And once we learn how to use these moving averages, and we combine it with things like RSI, or we combine it with things like MACD as well, or just candlestick analysis or price action in general, or level 2 momentum, we can get a very good gauge of where to take profit. But just to summarize very quickly, right? To go into a long position, you buy it when it crosses over like that, or when you're anticipating a crossover. Obviously, here it would have been a great place to buy it in hindsight, but that's in hindsight, right? So you would have bought it on the crossover, and you would have sold it on the crossover. You would have shorted on the crossover, and you would have closed your position on the crossover again. So that's pretty much what you do, guys. You buy it on the crossovers and you sell it on the crossovers, and it can work on any time frame, even on a 5-minute time frame, guys. Even though the swings are not that much, sure, you can buy it on you can do it on 5-minute time frame as well, right? You would have shorted right there. You would have closed your position right there for a 4% gain. You could have entered a position there. You could have almost getting ready to close it for another 4% gain. So it doesn't really matter what time frame you guys do this on. You'll find the confluency, or is that even a word, confluency? You'll find confluence on every single time frame. And this moving average strategy is definitely one of the best swing trading strategies that I have ever come across, because it doesn't really require a lot of monitoring. You can anticipate and extrapolate a lot of the information that is about to come as well. And it's really easy to tell that from right here, for example, okay, just from right here, that it's about to cross over, right? So when you anticipated it's about to cross over, you could easily get yourself into a decent position. So that's personally what I think that we're going to be you guys are going to do very well, trust me, using this strategy. I've gone over many different scenarios on many different time frames, and I think if you guys adopt this to one of your strategies and also add RSI and MACD and candlestick analysis and price action analysis as well into your swing trading strategy, you guys can actually become a very successful trader over time just by taking a few of these trades a week. They are what I would call a high probability play, and the worst case that can happen, in my opinion, is you get stopped out. But if you take enough of these trades, like we're talking about 10 of these trades a month, right? You might lose 5. You never know. You'll lose 50%, but the probability of you winning is higher. Actually, we should say about you might lose 40%. If you win 60%, great. Risk to reward is not very much so predefined yet, because we're more so riding it to see how we can maximize these profits and minimize our bottom line losses in general, right? So if you stick to these strategies, I think that you guys are going to be very profitable over time. And there's no doubt in my mind that the profits are going to roll in. You have to stick to a very basic strategy first, okay? Stick to a very basic strategy, because the last thing you want to do is pick a very overwhelming and advanced type of strategy. The strategies that you'll see in lesson 17, they are very advanced, where you're looking for bearish signs of divergence on RSI and using pretty much every form of technical analysis and every tool, every weapon in your arsenal, right? So those are more advanced types of analysis. But if you stick to specifically this strategy alone, guys, there's no doubt in my mind that you're going to make some good money. How do I know? Because I've made some incredible amounts of cash trading this particular style. And I definitely believe that you guys will also have an incredible opportunity if you master or practice this style a lot. So this will conclude our lesson, guys. We've gone over about an hour in these particular lessons already. This one was lesson number 12, right? We talked about the swing strategy story. Sorry. What are moving averages? How do we identify a bull or bear market, right? One thing I wanted to brush up very quickly on was that what we try to do is we try to identify and keep this in mind, right? We identify a short-term bear market, right? A bear trend. So if this is a short-term bear trend where we're getting these moving averages like that, we also ask ourselves, is it happening on the 2 hour chart? Is it happening on the 3 hour chart? Is it happening on the 4 hour chart? Is it happening on the daily? If it happens on the daily, then that's where you know that unfortunately it's going to end up, um, if it happens on the daily, that's where you know that the greater degree has now been confirmed on a higher time frame. So, for example, here, what we see is we end up getting a death cross right here, downwards, right? This is a death cross right there. Then we end up getting a golden cross over again, going to the upside. And then we actually end up looking like it's going to get a. Sorry, we ended up death crossing, then a golden cross upwards, and it looks like we're about to get a death cross right now as well to come down on the downside. So that looks pretty scary, right? So a lot of people will actually enter short positions from here, if you notice. So if we confirm it, if we can confirm it on a shorter degree time frame, like a 1 hour, 2 hour, 3 hour, it can cascade and move over to the higher time frames, which will also confirm a greater degree. So that is the importance of a high time frame and a low time frame. You might get signs that it's looking bearish in one time frame. Well, will it actually carry over bearishly to a higher time frame as well? So I hope you guys have enjoyed this lesson of mine. A lot of energy has been put into it because I want you guys to be very successful with this strategy, which will also lead into our lesson 13. What is the MACD indicator? And what is the MACD and histogram, I should write? It's one of my favorite indicators. How do we use this to actually time entering a small position, or maybe it's a short as well, or it's a short day trading position as well. I apologize for stuttering there. So the MACD and the histogram, it's one of my favorite tools that we can see. The histogram gives us a very good gauge of these ladders and these stair steps that can move up and down. That tells us its overall progression, whether it's moving up or down. And it's a real-time momentum gauge as well. Whereas the MACD is a lagging indicator. It'll take the previous price action and compile it into a line, right? That's how we're getting this moving average convergence divergence. But when we combine it with RSI and histogram as well, we can find a lot of confluent reasons to enter a trade. And I think that when we combine the swing trading strategy that you guys are most likely very familiar with now, and when we combine it with histogram and MACD and RSI, you guys are definitely going to improve your skills as a trader. So thank you very much for joining me for lesson number 12. I look very much so forward to seeing you guys for lesson number 13, where we'll be talking about the MACD and histogram indicator and just more about general strategies in general. So I hope that you guys have taken a lot away from these classes and these lessons, especially the previous one where we've talked about moving averages. I thank you for joining me for the class, guys, and have yourselves a wonderful day. And I will see you for lesson number 13, where we'll talk about MACD and histogram. Bye now. Have a great day. Take care.